This week, I'm going to start by talking about a conversation I had over the weekend, and I'm going to finish up by discussing the upcoming non-farm payroll report in the U.S. Over the weekend, I was speaking to a friend of mine. He's head of research for one of the Swiss banks, and he told me that he was going to go on to financial television on Monday morning, and the first question they were going to ask was, how does he help the clients navigate financial markets with all the volatility caused by Trump and his tariffs? And my suggestion to him was that he should push back against that question. He should tell the reporter, well, historic volatility, the recent volatility in the S&P 500 is below average. Actually, I just checked that before I sat down here. 20-day historic volatility of the S&P 500 is at 14% right now. Long-term average volatility is over 17%. So we're definitely below average volatility for at least the last month. And so markets, clients don't really need to worry much about navigating Trump-caused volatility because volatility is just not there right now, or it's below average. And at the same time, of course, the U.S. stock market has been doing very well lately. So it's actually been a very easy market for U.S. equity investors, and they don't need a lot of help navigating it. When I made those points to my friend, he kind of got a little philosophical, and he says, when I'm talking to private clients, they're not financial professionals, and I usually avoid going into things like volatility. It makes financial markets sound very complicated. It makes it sound like it's very difficult to make money in financial markets, and basically dissuades people from investing. And I said, that really comment he made really resonated with me, because I remember when Trump first got elected, I went to a presentation given by one of the Singapore banks, not my parent bank, and they had their economist there, and she kind of let in like a little humorous thing where she was talking about markets and this and that, and she said, oh, but I have to worry every night about all the troubles created by the volatility from Trump and his tweets. And she got a big laugh from the audience. But I didn't laugh at all, because I thought this was just a bad comment, because anybody who was following the U.S. markets at that time would have noted that, would have easily seen that the U.S. stock market was pretty much going up every day after Trump got elected. It was going to new high after new high. And actually volatility, as I characterized the present volatility as being, kind of normal, just a little below average, volatility at the beginning of the Trump administration was actually low. It was way in the low range. So you had a very calm market that was generally going up every day. It couldn't have been better for investors, and she was making it seem like it was just some market filled with minefields. And I didn't realize how dangerous those kind of comments were until a couple of years later, where I met someone who was a former employee of that bank, and that person said to me, he goes, I remember that presentation as well, and that dissuaded a lot of people from investing in the market. So those sorts of comments just cost people money, and that sort of goes along with what my friend was saying. It's best not to talk too much about volatility and these other things to clients, because it basically makes financial investing more complicated than it needs to be. On that topic of complicated, I just wanted to share with you how complicated volatility actually is. When I was studying this stuff, when I was much younger, we learned a model for predicting volatility. And I got Josh, the intern here, has got to read out the name of that model. Go ahead, Josh.
Generalized, autoregressive, conditional, heteroscedasticity.
Yes, and the moral of the story is anything with that complicated name, you can be pretty sure doesn't work and won't help you make any money. So, to go back to where we stand now, For the last, May was the best May for the S&P 500 since 1990. The S&P was up about 6.5%. I already said volatility was below average, so it's been a really good market for investors. And what do people want? They want that to continue. Now, the non-farm payroll report is coming up on Friday. That's usually a big event on the financial calendar. Is that something that could derail the present wonderful market that we're having? Well, usually, or at least for the last couple of years, what the market has wanted to see from those payroll reports was a little bit below expectations in terms of job growth. Last month, I think the April report showed 177,000 jobs created. They're predicting in May it's got to be 170,000. If you get a number like 160 or 150, that would just be sweet for the market. Why do they want it a little bit below expectations? Well, because the job market, showing that the job market is cooling, is probably encourages the Fed to cut interest rates. Right now, the Fed isn't expected to cut rates until September. However, we had a PCE report and a CPI report recently that showed inflation dropping more quickly in the US than what was expected. So the Fed probably has the flexibility to cut sooner than September if they want to. So if the job market's a little bit cooler, of course, that would increase the argument for them cutting sooner rather than later. If it's much, much lower than expected, then people would start worrying about whether there's got to be a recession. Is there a chance that that the job number will be much worse than expected? It doesn't seem so. We had another job number out last night in the US, the JOLTS report from the Labor Department. It showed job openings, meaning employers advertising for jobs in April, higher than expected. That indicates a good jobs market. The PCE report from last Friday, which I already referenced, it has the income part of that, and that was the most surprising number in the report. Month on month, personal income in the United States jumped by 0.8%. That was 3 times the expected number. So people are earning more money. That kind of falls in line that the labor market must be doing okay. So I would say that the risk of the jobs number is a much higher number than expected. That would mean that the US economy is doing better than expected. Probably that's what it means. That would mean that the Fed would be even more reticent to cut rates until it understands the implications of Trump's tariffs on inflation, and that would be bad for the market. I'll end with saying one caveat against that argument is that the market already knows right now the US economy is doing pretty darn well. In the first quarter, the US economy stalled a little bit, but in the second quarter, right now, the Atlanta Fed GDP nowcast of how the US economy is doing is showing that it's growing at a 4.8% rate. That's a very high rate of growth. The numbers for the first quarter and this number are distorted by the trade patterns. A bunch of imports went into the US in the first quarter, which deadened GDP growth, and they kind of got slowed down in the second quarter, which is elevating GDP growth. But if you look at the two numbers together, things look pretty good in the US. So we have a fairly solid economy, and we have the S&P very close to an all-time high. So I don't think the market will be too upset if you have a strong number. And I think it would be very happy if you have a little bit of a weaker than expected number. That ends this week's report.